Let's talk some more about the situation at hand, not just from the macro side, but sectors and perhaps secular growth stories that can live on with or without stimulus. Kevin Kelly is joining us, founder and chief executive officer at Benchmark Investments. Kevin, good to have you back on Market on Close. So let's talk overall here about the equity situation. Stimulus, no stimulus. This market's been running just fine without it, Kevin. Does that mean that we have to have a big deal for stocks to keep going?
No, it doesn't at all, actually. I don't think you need a stimulus package to even happen for the markets to continue to go higher. And I think the reason why is you're seeing a lower correlation within the sectors of the S&P 500. So tech, it actually only has about a quarter correlation to healthcare. It's got about a half correlation to discretionary. So I think there's actually a conducive environment, and that's because of fiscal and monetary policy. So this is nothing new. I'm not shedding some profound insights that you haven't heard before, but you also have the inflation queen, Janet Yellen coming back, and she's going to pair up with the inflation king, which is Jerome Powell. And so you're starting to see it trickle into asset pricing, right? You started the top of the show talking about oil, right? You were talking about copper, right? How about an asset class that you just recently started venturing into, Bitcoin, right? So the dollar's going down, right? Assets going up. So I think you've got that huge tailwind behind it, regardless of a package that happens. Then you've got sector correlation dispersion, which means there's healthy markets, right? You don't want everything to go all up at once and everything to go all down at once. So now that we've got sector dispersion, that's conducive. The last conducive thing that's actually a huge tailwind, I think, for the market is the $4 trillion in cash that's sitting on the sideline praying for a pullback. So I think you're going to see that money trickle in to the market and actually, lend credence.
Let me take a few of those one at a time. Why inflation queen and king? They never got any inflation, Kevin. I mean, I know you're kind of making the case here that maybe it's in the assets.
What are you talking about? College education, to go to college, it's gone up significantly. How about housing? How about the, everything under the sun that people are spending real money on? Inflation has gone up significantly over the last 5, 10, 15 years, right? When did you want to go to college? 30 years ago when it cost nothing. Do I want to go to college 5 years from now? Absolutely not.
All right, so just not the way we measure and base any tools off inflation. So in terms of what that's actually going to do going forward to change the dynamics, I mean, they're not changing their policy based on tuition. Maybe you can argue they should, but they're changing their policy based on the prices of other goods and the traditional measurements. So is that going to show up?
I was talking asset inflation, right? Asset inflation. That's what their policies are doing. What have assets done since quantitative easing and Operation Twist and everything else that has happened? Assets have gone up. Look at housing, gone up, right? Stocks, gone up. Bonds, gone up. So if that's not asset inflation, I don't know what is. And then you have that asset inflation king and queen at the helm. So, that just bodes well for 2021, 2022. The asset inflation stops when the actual markets want to monetize the debt that is fueling the asset inflation.
So, Kevin, in terms of whether or not the pace of what you describe as asset inflation due to policy, how are we going to gauge how much policy leads to how much of that asset price inflation as you describe it? I mean, is it just binary? Okay, one goes in, the other one goes up, or is it the amount that you put in will create a different amount at which these assets go up? Because right now the Fed is basically steady. They're not changing anything. We learned this week the Powell's not going to change anything. He's going to keep buying the same amount of bonds every week, not more, not older bonds. But yet we've still had the yield now climb for 3 months in the Treasury. So is there a rate of change element that matters as well here? Markets went sideways for 3 months. Until we got the vaccine, we were well off the highs for the NASDAQ and a little bit off the S&P, despite the fact that he was still buying hundreds of billions every month.
Yeah, so I think we need to separate the short-termism of the last month, 3 months, which had a lot of macroeconomic events, including an election, and putting it into a regime of volatility, right? So if I go back to 2016, middle of 2015, right, when we had this huge episodic volatility due to the anticipation that the Fed was going to raise rates for the first time, right? And then you had the Chinese devalue their currency, and then you got August of 2015, right? And if we start there and go to the end of 2019, what did the VIX average? 15, right? You had episodic bits and fits, but overall, the market went up. Overall, inflation went up. Overall, it was a great time to invest, right? So yeah, there were times, especially during the end of 2018, during quadruple witching, which we're in right now, where the Fed said they were going to raise rates 4 times and then they didn't. So I'm looking at it from volatility regimes. We are actually going down in volatility due to the policies. Will there be times where, yeah, interest rates can go up for a little bit and then, we may have some sideways markets? Sure. But if I'm looking at it from the policy standpoint and on an 18-month to 36-month time frame, this is a great time to invest, regardless if the Fed stays the same. As long as they don't start to taper. Remember when they mentioned the word taper, the market lost its mind? I think it's going to lead to asset inflation vis-a-vis stocks, vis-a-vis real estate, vis-a-vis housing. I'll give you an anecdote. How about this? Industrial real estate, which I specialize in, is up 6% since August. 6% since August. And there's no asset inflation. You were talking about interest rates going up. You were talking about all these other things. Who cares? Right? Over the long term, it's going up. Why? Because the policies and where we're at.
Kevin, since you mentioned volatility, let's pull up a long-term chart of the VIX here. It looks to me like we've got a floor of the VIX that's gone up a little bit. We were back in single digits in 2017. We got the explosion. Yep. Then the year after that, we pushed up our baseline to around 11, 12. Then we pushed it up a little bit further, and now we can't get through 20, and despite the fact that we've got more getting pumped into this economy than ever. So where is the asset inflation here? I mean, it's not moving directly towards, the point is that it's not direct, right? You can't tie it one-to-one because right now we've got a ton more money coming in from policy than we did on the left side of this chart when VIX was much lower. I mean, obviously we've got a stock market that's higher, but you got to factor in earnings and everything as well. Point is that really the only thing that anybody needs to think about, Kevin? Is that the only thing I need to know as an investor, that as long as Jay Powell's going to keep buying the amount that he is every month without change, that I can just keep buying stocks? Is that really it? That's all?
I think that with the backdrop of the macroeconomic statistics that come in that show you that, yes, when we're not in lockdown, which we got back into now, the economic data is showing we were getting better and healthier as an economy, right? So what we need to do is look at the demographic changes that are happening not only globally, right, where you've got emerging consumer in the emerging markets, right? So when you look at companies like C Limited, right, which has done exceptionally well, when you look at all the companies in China and doing exceptionally well because of a growing consumer class, right? So look at the macroeconomic data when you're in a normalized market, and then you look at the policies and you couple that together, and you're going to see a volatility regime that should go back down to 18 and 15 like we had from 2016, 2017, 2018, and 2019. Hey. So you couple the data with the volatility. And so let's just take a step back though. VIX, what is it? It's a 30-day indicator of uncertainty. That's all it is. So it resets all the time, right? It's only looking 30 days out in advance, right? How am I investing my capital? I'm investing my capital for 18, 36 months for the long term, right? Sure. So I don't care what happens within that 30 days. As long as the economic data keeps getting better over the longer term and volatility keeps coming down, that's going to lead to asset inflation and better portfolio return for Kevin Kelly.
All right, hey, Kevin, last thing here, because as you make the point that the most important thing still is the Fed's support for markets. I was talking earlier at the show that what I tie to the breadth widening out in the market the last month is COVID surging back. And you could kind of connect that in towards policy as well, as investors have been expecting expedited policy. From what you're describing then, is this a scenario where good economic developments then really are the only thing that can get in the way of the stock market, the potential for a faster economy that then pushes the Fed out? I mean, is that the flip side? It seems like that would be the logic of what you're saying.
Yeah, it would seem like it's the logic, but when you look at markets, right, the macroeconomic data is going to reinforce the real economy, right? And so the real economy is going to take a long time to heal. The market is a forward-looking indicator that's going to focus on basically what's happening globally and with the backdrop of the U.S. economic regime. Right. So what I mean by that is we've seen it where good news is bad news for the markets and it pulled back. But we've heard from the regulators that even when we've gotten good news, that should lead to policies where they would start to, taper or pull back, the fire hose that they're throwing at the market. They're like, well, we're going to wait and see. We're going to want to see a couple quarters. We're going to want to see a year, right? So that's why you've seen the market do well against a terrible, macroeconomic environment, because the stock market is not the economy, and the regulators know that, and that gives them an out to keep accommodative policies, despite how well the market or the macroeconomic environment is doing.
All right, so you're saying even as things do get better, they're still going to stick around by it and keep pumping things up. Okay, all right.
Of course, absolutely. Right. It's their legacy, man. They don't want to be the one that was there when the market took a free fall. Absolutely not. They want the good books. They want the good speaking engagements. They only care about their legacy and their own pocketbooks as well. They're human.
All right, we got to go, Kev. We're off track, but we'll get back on. Appreciate it, Mr. Kelly. Good stuff. All right, case here made that no matter what happens, Fed's got your back. Kevin Kelly's the founder and CEO of Benchmark Investments.